And you can read all about the Fed's tall task on fighting inflation while also facing a banking crisis in today's morning brief written by our Miles Udlin. That's up on the Yahoo Finance homepage. Joining us for more on the challenge here is John Stoltzfus, Oppenheimer Chief Investment Strategist. And of course, there's the Fed challenge. And then there's all of our challenge, John, when it comes to trying to figure out how to play this. You titled a recent note, Riders on the Storm, as an illustration of it's not an easy environment right now to try to navigate. So I believe you're in the quarter point camp right now. How do you play it?
Right. Well, great to be on the show with you, Julie. It's been a while, and it's great to be back. I've got to say that, we think the way to do it is stick with growthier value and GARP growth at this point, diversification across market capitalizations. And as well as, so you've got style, and then within the sectors, stay cyclicals over defensives. We think the defensive call is a little bit late. You want to be in cyclicals and in GARPier growth at this point with growthier value.
Okay, and so with all of that considered, I mean, is it too late for someone to enact that play within their own kind of Fed playbook right now, or Fed adjacent playbook, knowing that the decision's coming later on today, and then now going out into the future, perhaps we'll get a little bit more of the inclination of what the Fed foresees and how they may continue to kind of parse through some of the range of impacts that we've seen, whether that be in banking or whether that be just on their benchmark targets.
Yeah, Brad, I think the challenge that the Fed is going into here really is one in which it needs to show that it is going to consistently deal with this inflation situation that has proved stickier, while at the same time showing a large amount of sensitivity to what the effects of its policy is to the economy as well as to the effect on inflation. There's this balance it has to do. Yes, it is a tightrope in essence, but the Fed, the most important thing here, I think, is with this confidence crisis that we had within banking, and we'll likely, still have to weather some aftermath of that storm over the course of the next few weeks or months. The reality is the most important thing is not what has brought stocks down once they've come down, but is what the response is. And thus far, that consortia response of the Fed, Treasury, the FDIC, as well as individual banks that have gotten involved in one case in particular, we've got to say it looks good, and we think that for investors, it really just depends upon their tolerance to risk. And are they traders? Are they intermediate or long-term investors? That's all up to them and their advisors. But we feel at this point confident that we are headed out of the woods, if not yet out of the woods. And we think the light at the end of the tunnel is not an oncoming locomotive, but is indeed sunlight.
And what are the conditions that sort of allow you to believe that? In other words, it sounds like you think that the worst of a banking crisis has now been contained, addressed by those various parties that you were talking about. It also sounds like you don't think the Fed is going to make a so-called mistake and drive the economy into a sharp recession. Is that fair to see it that way?
Yeah, we do think that Jerome Powell does not want to be remembered as having to take in draconian actions as Volcker had to, and we don't think he has to because he didn't have an Arthur Burns in front of him, and also doesn't want to be remembered as an Arthur Burns who doesn't address it. The Fed is highly communicative, and while it isn't infallible, it is highly capable of pivoting, as we've seen over the course of the last few years, when it does get behind the curve or gets ahead of it, as it did in 2015 to 2018, when it was hiking earlier on. So we just think that the Fed is doing the right thing. They're experienced, but it doesn't mean that we won't experience volatility. It's just that it's digestible by the markets, at least, since the lows of October last year. Through now, it's been pretty steady, the positive sectors that have been showing good performance, and it shows a confidence that's a lot more than blind by the dip kind of action by investors.
John, we're showing our viewers the Fed rate predictions from each bank this morning, and even in my notes, I had written these down and put kind of an LOL next to Nomura, really standing out there. But I mean, at the end of the day, if we were to see some type of major pause or a cut even, what do you think the Fed would also have to say in tandem with that?
I think it would have to say that it was doing this as an effort to stem any kind of situation that it might feel could come up. A lot of times when you have a crisis like this, very much like in a hurricane, the next day the sun comes up, it's a beautiful day, but if you go in the water, you have to be careful because you might get hit in the head by a 2x4. It'd have to show a relaxed kind of way to explain it. But the market, I don't think, would be very happy with a pause or a cut. But I think 25 bips, I think, when we move towards greater stability with a realization that the end of free money is actually a good thing, in that it will bring, hopefully, the markets back more to be attuned to developments on fundamentals than on the latest meme idea or crypto coin,
There's another, to sort of circle back around to strategy where we began this conversation, John. One of the areas you like, and you talked about cyclicals, one of the areas you like is technology, established technology companies. And it has been really fascinating to see tech come back, right, in this environment and seen almost as an area of safety. What do you make of that?
Well, I think, I could try to downplay any kind of safety zone on anything. I think that this SVB bank kind of showed that even treasuries aren't safe. They forgot Finance 101, that you have to watch the maturities that you own and will look towards liquidity in a rising interest rate market. Apparently, that's one of the problems there. But so I would certainly place that with technology. You've got to watch it. But the idea, I think, that the market has been saying is just it was desperately oversold. The problem with the way technology was sold in 2022 is it lumped both established companies as well as long duration technology companies that may not see positive cash flow for years of profitability in with well-established companies that we as consumers and business people depend upon every day. And while we may not wait for every upgrade with bated breath, we most certainly need those upgrades, and we're looking for the latest products to help us work more efficiently in a very fast-moving environment.
Well, you certainly have us on the end of our seats waiting with bated breath for all of your notes as well. John, we appreciate the conversation as always. John Stoltzfus, who is the Oppenheimer Chief Investment Strategist. Thanks for your time this morning.